Keto coffee right before a video. Welcome to the channel, everyone. My name is Jack Graham, your Las Vegas and Henderson Realtor. Today, I'm going to be talking about the problem with waiting for a market crash. I'm going to go over different case scenarios, and if the market is going to crash in a year or not, if it's going to keep going up, and how will you react to this? How will you make a decision on whether or not it is a good time to buy? And also at the end, I'm going to give you my opinion of where the market is going and also what I am doing in this situation. And let's get into it. But first, like the video, subscribe to the channel. That way you get notified every time I post a new video. So I get a lot of people coming into open houses that I do as a realtor, and they tell me, hey, I'm not going to buy right now just because I'm going to wait for the real estate market crash that is coming next year. And this has been happening for many years. In fact, every time I see these people, I say, hey, up to you. If you want to wait, go for it. But there's an issue with this. Just to let you know, I do get it. At the end of the day, this is the biggest purchase of your life, most likely for most people. So I understand what it means to purchase a home. The thing is it a right decision for you to wait or not? So I'm going to give you the first case scenario, which is, let's say next year in 2021, the market tanks and you are going to buy eventually, right? Now, the question that I have for you is, let's say the market is tanking. Let me get my whiteboard. Here we go. This is a graph of the real estate sales price, and it's going up like right now, right? We've been having this trend upwards, right? And let's say right here we're topping off on the mountain right here. We're topping off the graph right here, right? And let's say there's going to be a market crash. If the market starts actually crashing, when do you know that the market is actually done going down? And that's the question that I have for you. Will you be able to catch a falling knife? Are you going to hurt yourself? Let's say we are right here, right before the crash, right? And you're thinking, hey, the market prices are going to go down. I'm not going to buy right now. What makes you think that when you're right here, that you're going to buy then? How do you know when the market actually bottomed out? Most likely, because of the mentality that you're in right now, you're thinking, hey, such a negative mindset. You're thinking, no, real estate prices are going to keep going down and they're going to go down to zero. That's what you're thinking, right? So you're waiting and waiting. And then let's say maybe there's something happens right here where purchase prices actually start going up again, right? For whatever reason, you're like, oh no, there's going to be a double dip recession and prices are going to go down again, so I'm not going to buy again. Meanwhile, you're waiting, right? Let's say you don't even own a home and you're renting from somebody. You're paying rent every year just because you're waiting. And the question I have for you is, how long is this time period right here? How long are you going to wait for that to happen? And will you be ready to purchase by then? I'm going to give you an example. We had purchase prices right here. Let's say this is 2005. This is a graph of pretty much what happened back in 2005, 6, 7, 8, and 9 when we had the real estate market crash, right? We had the prices go up, then they tanked, and then they kept going back up to what we have right now. Let's say right here you said, hey, I'm going to wait so I can buy down here. This time frame right here from 2005 to 2010, which is when the market actually bottomed out, this is 5 years. Right? So for 5 years, you will have to rent another place because obviously you're not buying for 5 years to get what? A 30% discount. So if you're purchasing a home that is $300,000 up here, that means that you're waiting, and let's say you're renting a home for $20,000 a year. Okay? That means for 5 years, you're paying the landlord $100,000. Okay? 100K. Now, out of this $100,000, if you would put it into the mortgage, I understand that doesn't go all to the principal, but most of it does, right? Let's say 50% goes to the principal. Although there's other things that we have to consider, such as tax reductions and all these things. But if 50% goes to the principal, you just gave them $50,000, right? So as you can see right here, it's expensive to not be in the market, regardless of what you're doing, because if you're renting out a place, and this is just for properties that you plan on living in, if it's a property that you plan on it being an investment property, then it might be a little bit different. But just to give you an idea right here of what you're looking at. The question that I have for you is it worth it for you to wait when you still have to pay rent somewhere else? So does it really make sense to wait? Another thing that you have to consider is, when will the market stop crashing? Will you be able to catch exactly when it bottoms out? And you have to consider, if you're renting also, you most likely have a 1-year lease. So you can't just buy right after you entered a new lease of a year. So you will have to wait for that year to end. And when that year ends, it most likely won't be exactly when you plan on purchasing. Another thing that you have to consider is, if actually real estate prices go down and we get a recession, that means a lot of people are going to lose their jobs. And if that happens, you are likely to lose your job as well. So if you don't have a job, you probably won't qualify for a loan, and you won't be ready to buy when the market actually bottoms out, which is one of the reasons why a lot of people weren't able to purchase a home back in 2010 to 11 and 12, and people were still renting, and it was so difficult to get out of that recession. But, you have to look at your own situation. Does that make sense? Does it make sense to wait? Anyway, the main thing about this case scenario is that if you're waiting right now, you're likely going to wait later, and you might miss out the bottom of the market anyway. And the most important thing is the time in the market, not timing the market, like many people say. And it's easy in hindsight to say, hey, I'm going to purchase, when it bottoms out, just like 2010, that's when I was, when I wanted to purchase properties or whatever, but it's easy to talk about it right now and think, hey, if it happens again, I'm going to do it. But when it does happen, you can't see the future, and it's a different case scenario. So we talked about if the market actually tanks, but we don't know that. And as a matter of fact, there's many reasons why I would believe that the real estate market has not bubbled up at all. In fact, I'll tell you, the last 6 recessions that we've had in the last 100 years, real estate prices have not gone down at all, other than the 2008 recession. And the reason why the 2008 crash happened is because it was a mortgage crisis. We had people that were getting loans, the so-called ninja loans, which is no income, no job, no assets loans. And anybody could walk into the bank and get a loan on a property. And what that did is it inflated purchase prices because there was so much demand created by false buyers, people that shouldn't be able to buy. Nowadays, that's not the case scenario. So just off of that data, I would think it's going to be difficult for prices to drop. In addition to that, people right now have a lot of equity in their homes, and most likely, if there is some kind of correction, people are still insulated with their equity that they have. If prices go down 20%, but I own 50% of equity in the property, I'm most likely going to keep the property and ride the wave out. So who cares, right? Whereas in 2008, everybody was over leveraged. They purchased at the top. And then what happens is prices went down and it didn't make sense, right, to keep the property. But many people are worried about the evictions, which is a good concern. It's good to think about that. And I'm keeping an eye on it myself. As of right now, we have 136,000 households that are subject to evictions, whether it's going to be rental properties or owner-occupied properties, people that live in it. There's a lot of people that are subject to eviction. And in fact, the eviction rate went up from 4% back in 2019 all the way up to 10% right now in Las Vegas. And it's something that we need to keep an eye on. That's why you need to subscribe to the channel. That way I let you know if anything changes in the economy and what's going to happen with the real estate market. But anyway, what happens if prices actually start going up? And let's get the whiteboard again right here. What happens if you're trying to purchase and home prices actually keep going up? So prices are going up, right? And then right here you think, oh, I think prices are going to crash. When you could have bought, for example, you had a chance to buy, but you didn't. Oh, prices are going to crash. And then prices keep going up and prices keep going up, right? Until eventually let's say even then it happens and there's some kind of correction. So prices go down, there's a correction. before they go back up. Now you waited because you thought that the market was going to crash right here because you're trying to time the market, right? You're trying to time the market and you think, hey, the market is going to crash. No, but it went up. So you could have bought right here at the same price as later if you actually purchased before. And you didn't have to rent out a property during this time, right? So there's many things that you have to consider when it comes to timing the market. That's why I personally believe that it's not a good idea to time the market. Also, another thing you have to think about is interest rates. As you know, right now we have super low interest rates. It doesn't look like they can go any lower than that because the Federal Reserve interest rate is 0% and banks are lending on properties at 2.7%. I have some clients that even purchase at 2.3%. So interest rates are likely not going to go any lower. If anything, they will go up. And the reason why I think they might actually go up, maybe not right away right now, but in the future, is because there's a lot of inflation happening. And also, you know, because of all the debt that we have and the money printing and all those things, that's debt that the government has and they have to repay it back somehow one day. Where do you think they're going to get their money? That's how the government actually pays off their debt. So if interest rates go back up, then your affordability goes down. In fact, what you have to think about is every time interest rates go up by 1 point, which means, let's say right now they're 2.7%. If they go up to 3.7%, the home that you're purchasing, it's actually 10% more expensive to you just because of interest rates. In fact, the home that is $300,000 right now, if interest rates go up 1%, then the home is costing you $330,000 at the end of the day because you have to pay more money every month towards the interest rates. So you have to consider also your payments. How affordable is this home to you? If you're waiting for a market to crash, you might miss out on these super low interest rates, which is what every realtor tells you at the end of the day. Now, the thing is, I'm still purchasing properties. In January, I plan on purchasing another property where I'm going to live in. And also, I do plan on purchasing a fix and flip pretty soon. Although I am waiting for the short-term investment, which is the fix and flip. And I'm trying to time it well because that's where there's a little bit of risk. If it's a long-term thing, I don't care about it, honestly. I can, even if there's a crash and there's some kind of correction of 20-30%, I'll just ride it out because at the end of the day, I'm living in it. Or worst case scenario, even if I lose my job and I can't afford to live in the house, I can just get out of it, go live with my parents or something, and rent out the property. That's the beauty about owning real estate, that you can get out of the property. You don't really have many restrictions like people say, because you can always get out of it and you can rent it out. And as long as you purchase it for the right price, you're good. In fact, that brings me to what I'm doing, which is buying properties under market value. That is how I purchase real estate and how I suggest my clients to do so. I would never go and buy a property at market value if it was up to me. In fact, I don't do that. I always purchase properties with a little bit of equity in it. So let's say the home is worth $300,000. I would not purchase the property for $300,000. I would purchase it for $270,000, $260,000, $250,000. And that actually insulates me. In fact, if I show you here on the graph, let's say I purchase a home right here at the top of the market. And let's say the home is worth let's say $300,000, right? But what I did is I purchased the property for $270,000, which is right here, right? So I purchased the property right here. Now what I do have is this extra cushion right here. So if the market actually starts going down, I'm still insulated because I purchased right here, right? So that insulates me. Even in case the market goes down, I'm still good. I'm not going to sell the property. I'm not upside down with it. I mean, I could sell it right here and break even, right? So that insulates me a lot on the risk, especially if you're purchasing a home to live in. It really doesn't make sense, in my opinion, to wait. Now, for the short-term investments, which is, fix and flip, I'm waiting a little bit and trying to see how this situation, unfolds with the evictions that are going to happen. If the government doesn't do anything in January, I'm going to wait for that and see what I'm going to do. But if I'm purchasing for myself, I'm going to go into it and I don't care, because in the long term, prices are going to keep going up. In fact, if you think about it, ever since the 1970s, when Nixon took us off the gold standard, there's been a lot of money printing happening. And ever since then, we printed $185 trillion that was injected into the economy. Now, what happens is when the money supply goes up, also asset prices goes up because there's more money in the economy. It's just a matter of supply and demand. And that's what's been happening ever since the 1970s, where we've had this huge injection into the economy of money printed. And what that has caused, in my opinion, is an increase in home prices. In fact, if you were to buy a home back in the 1970s, it would be a joke compared to what it was right now. And that's where I'm seeing the economy is going to go in the future. Just this year alone, the government printed $6,000 for stimulus that they gave out to people. It is the most they've given out in a year. And they plan on printing another $2 trillion that is in the works right now. They're negotiating. So my point with this is that stimulus and money printing is going to inflate asset prices. And in the long term, even though there might be some kind of correction for the evictions or the increase in interest rates, in the long term, real estates are going to keep going up higher. And I wouldn't be surprised to see another 100% gain into home prices within the next 10, 20 years. So that's pretty much what I'm doing. I hope you found some value in this. And if you made it to the end, you must have found some, and you have to subscribe to the channel. And also, make sure to like the video and let me know in the comments what your thoughts are. What are you doing? What is your strategy? Let me know down in the comments. That way we can all see what you wrote about. And I'll see you in the next video. Thank you so much for watching.